You look at a co-founding team and there's like 3 co-founders on the team and 2 of them you're like absolute rock stars, would love to back them. And the third one, you're kind of saying, why are they on the roster? That's actually, it's not, hey, there's 2 great co-founders, I'm sure they'll ditch the third one at some point, but it's a reflection on their judgment. And if they've brought a weak co-founder on board, maybe they'll bring a weak employee on board, maybe they're going to be less likely to win. So that's probably one of the tests that we've come up with of, would you back each of these founders in a founding team, regardless of the makeup of the whole team?
Hi all, many thanks for joining us on Aulium. Today I'm with Markus, my partner in crime. Markus, hi.
Hi everyone. Great to be back.
And today, so we have the pleasure to be with Will Orde from Passion Capital. So for anyone who's been in the tech scene in the UK, Passion Capital is absolutely part of the infrastructure. And we actually can't wait to dig into the story and everything you're looking at. So Will, again, very nice to have you on board.
Yeah, great to be here.
So maybe to kickstart our discussion, Passion Capital, normally, I mean, it's a very big brand name in the early stage scene in the UK and across Europe, really. Maybe could you give us your definition of what, Passion Capital is today? I mean, the mandate, the types of founders you back, like the, check size, the stages, and how you like essentially to work, through a first meeting and, follow-ons, etc. I mean, if you could essentially give us the picture, that would be absolutely great to understand your current positioning.
Yeah, absolutely. Happy to. So Passion, one of the better established kind of seed-focused VC funds here in Europe. The Passion was founded way back in 2009, hosted one of the early co-working spaces, White Bear Yard in London. First fund in 2011. To date, we've backed just over 110 startups. We've had 5 fintech unicorns come out of that so far. Basically, all of the initial investments have been right down at pre-seed. So we like being first investor on the cap table. We completed a new investment last week where the founder had to incorporate the business so that they had somewhere to take money from us. Currently investing out of our 4th fund, thematically really focused on how great founders can go and disrupt fintech and enterprise risk using AI. As I said, first money in, no such thing as too early. In my lexicon, that's not an excuse that I'm allowed to use with founders. So the earlier, the better. If it's a couple of scratchings on a whiteboard and we get excited about the founders, we're in, we'll back them. Typically investing somewhere between 400 to 500K up front. Good capacity to follow on, build from that over time as founders go through the rounds. And that really means we're translating down into rounds of 400 to 500K by itself, up to 1 to 2 mil. That's the sweet spot for us. And then, geography-wise, backing founders all across Europe. That's us.
Okay, understood. So very early stage, as we understood, in terms of types of founders, I mean, are you looking for repeat founders, maybe to mitigate a bit the risk? I guess if you have, like, say, coming to you or legit persons, I mean, how do you make sure those persons will essentially push a business forward?
Yeah, I mean, there's a real mix in the founders that we back. So we've backed repeat founders going again where they've got a kind of a bit of a chip on their shoulder and they want to do bigger and better next time out. We've backed kind of ex-operators who haven't been in the driving seat but have experienced what good looks like. They've been on the kind of Series A to Series D, kind of 1 million to 50 million journey before, and they want to go and do it for themselves. And we back people who've got none of that on the CV, but they're just sharp and hungry, and you get your socks blown off and you go, well, we've got to back them. But it really all comes down to the founders. And that's kind of not surprising because when we're investing, there's no customers, there's no revenue, there's no product. So it's the people in front of you. That's all you've got to look at.
Yeah, that's really interesting. Is it ever too early or too late for you to get involved? So you mentioned obviously that there are stages and there's the pre-seed stage, the seed stage, etc. And you're in the pre-seed. From a founder perspective, could you maybe give a little bit more direction on at what point it might make sense to approach you? So maybe is it when you have the prototype or is it when you've just got some ideas? You already briefly mentioned at the beginning, but it'd be just great to clarify that even more.
Yeah, so there's kind of not a such thing as kind of too early, but there might be kind of the idea is not fully baked yet. If you come along to me and say, hey, we think we want to go and build in the wealth space, but we haven't quite worked out what we're going to do yet, then you'd be foolish to go and raise money on those terms. Because as soon as you raise money from anybody, VC, angel, whatever it is, external, you're that's the starting line to the racetrack, and you've got expectations you've got to keep up with that. We sometimes have founders that come to us and say, hey, I'm thinking of building, I'm really interested in this space, but I want to build with a co-founder, and I'm looking for the co-founder. Great, super interesting, let's keep in touch. And when you find the co-founder and that spark's there, and you're like, okay, we've got something real, we now want to really go for it, that's the time we'll jump on board. And sometimes that doesn't materialize. Like someone doesn't find the right co-founder, they fall out of love with the idea before they even get started, and that's fine, because actually sometimes those people go back, take another job, but introduce us to their friend who's actually going to found something. And a lot of the best deals we do come from the founders in our portfolio and from the founders that we talk to. So it's kind of friend get friend, network driven origination for us.
Okay, makes sense. So sorry, go for it, Thomas.
No, I was going to ask essentially like in terms of, so you're almost like a very, like a second co-founder, let's say, because you arrived so early. And would you help in finding the rest of the team? Or if you see like, 1-2 persons, but you identify a lack or, within the team, would you help essentially plugging someone in, or this you leave it to the actual people who have the idea?
Yeah, I mean, it's a really delicate balance to tread there. So look, we've got a good network. We get hit up by operators, engineers, people wanting to go and take on early roles all the time, saying, what have you got in your portfolio that's interesting? Who should I introduce to? We're happy to make those connections. But we don't want to kind of step over the line and actually like do the day-to-day operations in the business. We're backing the founders to execute, giving them our nuggets of wisdom, or as they may be. Hopefully it's nuggets of wisdom, not nuggets of disinformation. Trying to suggest to them, like, stop people making the mistakes that everyone else has made before them, where it looks like it's the obvious path forward, but it's not. A lot of the time is saying to founders, don't do that. Focus. Just focus. Don't get distracted. Then you'll get things right.
Great. And then would you say, so is there ever a formative miss or near miss where you'd say it has informed how you assess founders now? So is there like an example where you could say that was a time when we maybe missed out on an opportunity, or where we should have backed earlier and we changed our process as a result of it?
Yeah, I think when we look back at the things that have gone wrong, you can nearly always attribute it to the founders, because you say oftentimes it's not that nobody won the space at all, and there wasn't. Then the conclusion was that this is a complete waste of time. Nobody's built a good company there. It's just not, the tech's not right, the market's not right. Somebody wins, and so that means that kind of the team that you backed didn't win the race. Trying really hard not to get like too much scar tissue from failures that you then miss out on the next good thing coming along, because you've got a knee-jerk reaction to, we back founders with these particular characteristics before. I think kind of one of the tests that we kind of ask ourselves now, so the best founders have to be these kind of charismatic visionaries who can sell anybody on what they're doing, because they're going to have to go out there and sell some early customers to be the first customer adopting this new technology and going through all the pain of the early bugs and it not quite being right. But before that, they've got to go and hire their first engineer and some early employees. Before that, they've got to convince someone to co-found with them most of the time. And so if you look at a co-founding team and there's like 3 co-founders on the team, and 2 of them you're like absolute rock stars, would love to back them, and the third one you're kind of saying, why are they on the roster? That's actually, it's not, hey, there's 2 great co-founders, I'm sure they'll ditch the third one at some point, but it's a reflection on their judgment. And if they've brought a weak co-founder on board, maybe they'll bring a weak employee on board, maybe they're going to be less likely to win. So that's probably one of the tests that we've come up with of, would you back each of these founders in a founding team, regardless of the makeup of the whole team?
Okay, interesting.
So we've spoken about founders, how good they need to be, but the VC space is also very competitive. I'm sure it is the case in pre-seed. And well, now you have like a very strong track record, like with fintechs like Monzo or GoCardless, etc. And if we put that aside, let's say if a founder would ask you why you in my cap table, what would you answer? What would be your answer?
So the first and easiest answer is go and talk to our founders. they'll tell us that they really valued having passion on board. So the proof's in the pudding. And that's a big reason that when we're thinking about where we originate deals, it's network focused, because people are coming via other people they trust. So they come predisposed to want to work with us. The other answer is, like, the reason that we're really focused on the fintech and the risk space is it's where we've been successful in the past. And that means we've got to observe both things going really well and inevitably things going really, really badly. And so you can then, we got that deep depth of sector specific experience that we can then draw on and use that to give advice on what to do, what not to do, and how to form the strategy. So it's the relevancy of experience we can bring to the table that is what gets founders excited about wanting to work with us.
Yeah, that's very, very interesting, actually, that you say that. So that actually made me think of another point, because there are different ways of raising. You could raise through angels. I know for my first business, I did the majority through angels, and then there's the VC model. Not everybody's relevant for that, but some companies, are relevant because they're big enough in terms of the exit. So what would you say is the benefits of getting a VC involved, like really early on in the pre-seed stage, versus the model where you might get angels or friends and family to invest at an early stage and then go from there?
It's about ambition for the founders. If your ambition is to, hey, I'm going to build something to 10 million revenue, profitable, and exit at that point, or run it as a lifestyle business, if you can build a business that you're the majority owner of that's chucking off 1 or 2 million of profit a year and low teens of revenue, that's probably a great business for you. If your ambition is, I want to redefine how the sector works, and the goal here is to build hundreds of millions of revenue over time, and you want someone who's going to hold your feet to the fire and push you to get there, that's when you should look for VC.
And what about after the investment? So would you say great post-investment support? So what does that look like from you once the investment has happened, and then you're looking to scale the business in terms of hiring, for example, or other support, customer intros, investor intros? How would that work?
Yeah. I mean, once we're invested, the network's open. Our network's open to founders. And I kind of think about making the right intros at the right time. If you're a pre-seed founders and you've got the capacity to take on like 1 or 2 design partners initially for proof of concepts, if we make 10 customer introductions in the first month, they're going to be wasted and you'll have burnt those relationships. So it's about making those at the right time. And it's really on us to be adaptable to the founders. Like, some of it's down to their like personality and their characteristics. Are they going to work better on jumping on a quick call and just picking the phone up to them, or sending them a WhatsApp message? And if we've got people who are second or third time founders who've raised lots of money before, scaled businesses to 100 employees, they're not going to need help on the nitty gritty of like, how do I VAT register my business? If it's first time founders who've never touched any of it, it's, here's how you set up your option pool and make sure you do it right the first time round. Here's how you like explain what an option is to your early employees so that they value it, and they think of it as a real kind of, this is one of the benefits of getting in earlier. I've got this great option package that could be valuable for me. And so it's working out where we can actually be helpful, and oftentimes recognizing where we should just sit on our hands, be quiet, get out of the way.
Yeah, that makes sense. And you want to understand, obviously, at an early stage, sometimes as a founder, you might put years towards a business until you realize there's no business there. So in that sense, it's good to have to convince somebody else of the business, and then also get support at that point in time so you can fast pace the growth.
And if you go and look inside like unicorn stories and great successful businesses, nearly all of them have had little or big pivots along the way. And even those who haven't had massive pivots have had moments where they've been banging their head against the brick wall saying, this isn't working. And so getting people out of the kind of trench warfare attitude of, I just need to do this, up to the, hold on, we've still got 9 months of runway in the bank. Let's stop banging your head against the wall and let's go and like head off in a slightly different direction. It's time to roll the dice again. That's something that just like the perspective of not being in it day to day, but still being close enough to understand what's going on, trying to bring that kind of perspective to the table.
In terms of like sector focus, so you focus a lot on fintech, again, with like very strong successes so far. One could think that the fintech space is now a bit overcrowded, or maybe like the sort of fame passed already, like a few years ago. Where do you see essentially the cycle in terms of fintech today? So what's the current situation, and what's overbuilt versus where do you see opportunities there?
Yeah, I mean, it's really interesting because on the one hand, like fintech has undeniably been massively successful over the last 15 years. You've had tons of unicorns, the fintech sector's hundreds of billions of value now. On the other hand, global financial services is trillions and trillions of value, and the fintech is about 1% size of global financial services, based on the numbers that ChatGPT tells me. So there's still like a vast amount of techifying still to be able to go in the sector, and inevitably, like a JP Morgan or a Barclays, has got lots of tech under the hood, but there's still lots to be disrupted. And let's take an example. Look at the Office of the CFO. There's lots of software that exists, like right back from basic accounting software to workflow automation software that purports to automate and techify that space. But if you walk into any large enterprise today and look at the number of bums on seats in the finance department doing invoice processing and bank transaction reconciliation and prepping for the audit, it's loads of people running stuff largely on Excel and email. And that's processes that could not be fixed by just pure SaaS because you needed too much context. It was too different from business to business. But AI can solve for that. And so we kind of think that AI can be the step change where there's a whole nother chunk of fintech that just wasn't addressable in the previous era that now can be addressed. So we're not getting excited about people saying, I'm going to come and compete against these great mobile apps for managing your wealth or these great accounting software pieces, because they're all trying to innovate and adapt AI as well. We get really excited when founders come and say, here's a problem that SaaS and mobile didn't touch, that it's still living in the 90s, running on email or running on advisors, taking you out for a glass of wine over lunch to tell you about your portfolio or something. Those are the areas that you can really innovate.
Any like specific niche you would want like early stage founders to maybe discover, dig into for you and then come to you once they have a product? If you had to launch some sort of smart ideas out there.
Yeah, I mean, I don't have the ideas, or I'd build it. One of the pets, and so we're very we talk about interesting ideas in a kind of go fish type way where a founder goes, that's interesting, but I'm actually building over here and you think that's interesting as well. But hey, here's my go fish for you. All of the payment rails, Visa, MasterCard, Stripe, are built around human to merchant or human to human purchases. So it's how do I go and buy a t-shirt online and how do I process that transaction? I think the economy is probably going to look very different if you think about agent to agent transactions. Hey, I've got a small job of work to be done that's going to take 6 tokens. Who am I going to bid it out to, and how am I going to do that payment? Am I going to be doing micro payments in real time? Is there going to be some central clearinghouse that kind of clears jobs and there's a credit system lying alongside it? I don't know what the answer is, but it probably looks quite different to the payment setup that we have today. So if anyone came and pitched me an interesting vision for how they can build the payment rails for agentic payments for the future, that could be really interesting.
Oh, interesting. So you've given a little hint at what a potential founder could be looking at next. That's really interesting, Will. Thanks a lot. Just in terms of macro factors, so what would you say are the main things that you look at? You mentioned some factors already, but what about the macro trends that you look for the businesses that you fund?
Yeah, I mean, look, the largest cycle for us is really simple. We want to buy low, get in at sensible valuations, and actually that's more about like discipline. We say no to founders who come to us wanting to raise too much money off the bat because we're investing pre-metrics. So it's the main driver of valuation is round size and how much AI hype dust they put over it. And then it's a long-term game for us. It's 10 to 15 years, and it'll be about finessing the exit timing to try and sell into a peak market rather than a bad market where there's good liquidity and people are paying good prices as acquirers or as secondary routes to exit. And that's honestly one of the big learnings coming out of the COVID boom was that we and plenty of other VC firms thought, this is a great new all-time high. I'll hold on to the next all-time high and chasing ever after. And actually, at a certain point, you've got to say, we're doing really well here. Let's take some chips off the table.
Okay, got it. And so what do you think of regulation, really? Because, I mean, it's a space which is highly regulated, maybe more and more regulated, payments, lending, etc. Do you see it as some sort of obstacle now for early stage founders because you have like an extra hurdle when you want to launch like something in a regulated market? I mean, do you see it as, some form of a problem for the early stage?
Regulation can be intimidating. for new founders, and it can be a kind of a barrier to entry for new competitors coming in there, because it takes time, and you have to put a whole load of words on paper and put structure in place and hire a compliance officer to get regulatory approval. But it can also be very freeing, because if you lean into it and you say, hey, I want to build a new lending model, I'm going to go and get directly regulated to learn myself, you can then innovate. You're not, if you try and skirt around it and I'll rely on somebody else's regulatory status, or I'll rely on somebody else's paper to write insurance, your ability to really innovate is limited by the third parties that you partner with. And so I think at a certain stage, you've just got to front up to it as a founder and say, I want my destiny to be in my own control. Let's use regulation as to open up the freedom to really go for it.
Mm-hmm. So going,
yeah.
Regulation, I'm sure, is a part of your due diligence process. But how do you run due diligence for really, really early stage businesses, even just ideas? Like, how do you run your due diligence process? Because there is no numbers to look at, really. I mean, not much in some way.
No, there's no numbers, there's no product, there's nothing to actually sit down and hit with a hammer and see if it breaks. So you're really looking at the founders, but you're interrogating their thinking about the space. So we backed a payments network in Eastern Europe, Paypercut, earlier this year, completely pre-seed, hadn't got anything live in market, hadn't got anything there. And when specifically with the regulation, the question was, well, how are you thinking about approaching regulation? What's the timeline? What do you think you're going to be able to do before or after you're regulated? Who in the founding team has got the skill sets and really understands the regulation? Which is de-risking. Will you get regulated first time round, or is it you're going to get stuck in a painful back and forth with a regulator that you don't understand? And it's looking at both the skill sets and how they're thinking about it that gave us the confidence that they really know what they're doing, and they will be able to move faster around the regulatory hurdles than any competitors would be able to.
Okay, understood. So potentially you could execute on a new deal extremely quickly. Or do you have internally maybe some sort of a playbook where we say, okay, when we see something new, we need to wait actually a few weeks just to make sure that we are not, taking decisions with too much emotions?
No, the whole process from our side is we are focused on making sure that we win the best opportunities, much more than focusing on making sure that we don't invest in bad opportunities. And that's because of the asymmetric risk in VC. You can lose at most 1 times the money you put at work. You can make 100 times the money you put at work. So it's more costly to miss out on a fantastic deal, fantastic set of founders, than it is to occasionally miss something from a DD point of view that if we'd spent several weeks going over it, we'd have worked. So it probably takes us 7 days on average to get from being connected to a founder to offering to invest. And actually, it's a really good sign. If we're taking significantly longer than that to move through the process, there's a lack of momentum, and that probably just belies subconsciously we're not keen. So we're letting the next call drift into next week rather than saying, no, we need the next call tomorrow.
Yeah, really interesting that. You mentioned the founders there is an important part of your decision-making process. And I imagine the earlier you go in the process of the company, the more important founders are. But what about the other parts? So would you pick, say, a product over market or market over product, for example, in terms of what you look for?
After the founders, it's probably the pain point. Does it feel like an urgent pain point that's going to have enough scale to solve? How you're solving that pain point, that can change, that can iterate over time. So you can think about who the potential buyer might be, who might have this pain point, a CFO. They're most CFOs are mostly trying to make sure the business doesn't run out of cash that they're running, and they're trying to get out their monthly and their quarterly reports on time, and they might have time to improve or adopt one thing a quarter. So if you're kind of on there, yeah, that's definitely a problem, but it's number 20 on my to-do list, that essentially translates through to that's on my I'll never ever fix it list. And so there's no good if the pain point doesn't have that urgency around it. You've got to think about how that pain point, how you're going to be able to put a vision and a narrative around your product that means it'll be in the top 3 on your target customers to-do list. And then you'll have to do the early education sales, you have to build the case studies, but then they'll stop pulling you and saying, I need this deployed now.
Yeah. And that list is probably, as most founders will know, is probably a very long list. So much going on at the same time. So there's so much you could prioritize, right? But that's really interesting. And you're really looking at the thinking and the way that the founders are thinking and deciding in terms of their judgment as well, which is really interesting. So going a little bit into a deep dive around AI, and that's a huge thing that is very, very relevant at the moment. And you mentioned it's even creating a new batch of fintech startups that didn't exist before and could almost lead to another boom in fintech, right? What's the market backdrop that makes Emblematic so? There's Emblematic is part of what you're working on at the moment. So what is it that makes that particularly interesting for you right now in the AI context?
Yeah, it's Emblematic. A couple of founders based in Berlin with a really strong kind of fintech and AI background, really looking to go and build agentic automations for the office of the CFO. And so when we look at the office of the CFO, you see these large swathes of manual work where there's high contextual dependencies and lots of sensitive data. And actually, the problems are sufficiently complex that you couldn't just give Bob in accounts access to the ChatGPT API and say, have at it, automate your month-end close or automate your reconciliations, because it just wouldn't work. And so it's how do you put that into an appropriate product layer that you've got the guardrails, you've got the evaluators, you've got an appropriate human in the loop process that also then leads to an improvement in continuous learning over time and turn it into a real process. And it's the focus around how you get that really good within your specific things. And finance is one of those areas where there's no tolerance for mistakes. You can't send somebody the wrong amount of money, or you can't just miss an invoice and forget to pay it. Otherwise, you'll have a supplier jumping up and down on the telephone, howling at you, and real business consequences. So you've got to kind of think very carefully about how you build AI into that broader context. And you can deliver great results today, but it's really interesting kind of greenfield space. There's lots of people coming at the office of the CFO from different angles, but we think it's going to come down to who can build product that just works. And CFOs can have confidence in the fact that, I used to have a team of people doing this that I trust, and now I've got a smaller team leveraging AI to be much more effective doing this.
So what their moat exactly? So it's the fact that they are providing a product which is extremely sticky. I mean, once it's 100% accurate or quasi 100% accurate, it's really like a first mover advantage almost, which create the
I mean, you're wanting to get up to high 90s accuracy, but it's also you want to know what the things are that you can't process, so you send them down the human in the loop. The stuff that you do choose to process, you want to be 100% accurate on. It's combining the foundational LLM models with very sector-specific data that allows you to fine-tune product and then slotting that product into existing workflows so that it works properly for that use case. And you're not relying on the internal development team or the office of the CFO, kind of the accountants in those functions to be able to deploy that product. You've got to make it work for them. And so really, I'm a big believer that strongly opinionated product is what's going to make AI successful. It's not thin deployments where you're relying on the user to get the prompting, to get the context right. You've got to make it really simple for the end user so that all of the extra contextual information that you'd need is the same level of stuff that sits at the back of the brain of their junior colleague in accounts, and that they've learnt by doing the job for 2 years and being trained on the job. And that's what your product needs to do to be able to automate those workflows.
And so maybe could you elaborate on how you found the opportunity, or maybe on the first meeting you had with the founders, what caught your eyes, and how did you fall in love in some way? And based on the team, I mean, do you think they are perfect now, but do you think they may need some new additions in the next 3-4 years once they reach product market fit 100% and they are ready to grow?
Yeah, no. So we got connected to them by another early stage VC. So another VC fund who'd backed one of the co-founders at his previous startup where he'd had kind of a small exit, but had founded before, built that through to exit, had the chip on the shoulder for, I now need to go and do something bigger or better. And they said, and we'd co-invested with that fund before in the past, and they said, hey, interesting deal in the office of the CFO space. We think you'd be good people to partner up with this. What do you think about it? met the founders, loved the articulation of the pain point and how they were going out building products. And they had a real kind of just get stuff done attitude, had early design partners lined up and secured before they even had any product built. So weren't just going to try and build something perfect. We're trying to solve problems with customers first and then think about, okay, how do we then apply that more broadly to customers 4, 5, 6 after that? And good balance of AI native founders, but with some insight into how the office of the CFO actually functions in enterprise. And yeah, the founding team, like with founders, good mix of commercial and tech skills. They will need a lot more tech capacity. They will need more salespeople. And the challenge that they're facing, the challenge that everybody else is facing, is that I think in this new environment, there's a massive difference between hiring decent software developers and really good AI native developers. And so it's hiring the right people and not compromising on hiring quality when you've got no budget because you've just raised a small pre-seed round and you don't have that kind of fame of having been on the front page of all the newsletters that everyone wants you on their CV for Gold Dust. It's an unknown where people would be taking career risk by going and joining a pre-seed company early doors. And how do you convince people to join that? That's their big challenge.
Yeah, really interesting. I was wondering, just sort of on a more general note, in the AI space, in the past couple, I don't know, I'm sure you've been following, but in the past couple of days, the markets have been really, tumbling up and down, basically, but mostly down, unfortunately. And do you believe a lot of people are talking about a potential bubble in the AI space and a potential correction, but some are arguing that there's probably not going to be a correction. So do you have any view on that specific point, and how does it affect you as a VC when you're in a space where some people think there could be a bubble?
Yeah. So, I mean, we're building we're assuming there's going to be 7, 10 longer years journey in the businesses that we back. So we really care about how bubbly the market is in 10 years' time. And if we could be in a really great bubble in 10 years' time and sell out at the peak of that, perfect. That's fantastic for this fund. If there was a downwards correction over the next 12 months and the entry prices that we paid got cheaper, perfect. Love that as well. But no, more seriously, kind of when we look at the value that some of our portfolio companies are delivering into clients today using actually mostly ChatGPT 4.5, not even ChatGPT 5, there's real ROI that a kind of sharp-elbowed CFO would scrutinize and go, why are we spending all this money on this fancy new AI tool? Are we actually getting bang for our buck? Yes, we are. And so if you can see that in the space, I don't think it's a real bubble. It's not like the kind of internet bubble of the late 90s where there was no value actually being created by some of those companies. It's pure hype. Now, whether your Nvidia or your Microsoft or your OpenAI is overvalued, whether there's a bunch of ChatGPT 6 will make the market size that much bigger, and ChatGPT 7 will make it that much bigger again, of kind of continuous growth in application baked into this pricing, quite possibly. But yeah, we're simple folk down at the early stage of the market. We're just looking at, can you build a product that delivers real value for customers? Yes, tick, job done.
Okay, understood. So maybe like covering another of, so you mentioned Paypercut, which is another of your most recent investment, which is in the payment and buy now, pay later space, aggregation for SMEs space. Could you essentially elaborate a bit more on the sector? I mean, the landscape, SMEs, so they are based in Bulgaria, if I'm not mistaken. So they serve mostly like Central and Eastern European markets. Yeah, if you could elaborate on the sector they are in, I mean, why you thought it was an extremely strong market for you to enter, that would be great.
Yeah, so I mean, it's really interesting kind of, so Paypercut, they're building kind of payments play for online merchants across a bunch of the Eastern European countries. You have a lot of small local markets here where there are local payment methods. It's often non-euro currencies. You see that the local merchants, because they've got small home markets, go cross-border pretty quickly, so often have to deal with those problems. And if they go to the big multinational payments providers, they get a pretty bum deal because they're small markets and they haven't bothered to build specialized products there. So the net result is you can get a good tech solution from the big international players that's expensive, or you can get a bad tech solution from the local players that's at a decent price. And so there's a gap in the middle for good tech, good price. The BNPL, buy now, pay later aggregation piece is a really kind of particular to the market piece, that the approval rate from any individual buy now, pay later provider on a customer checking out is pretty low. That's not because the customer is necessarily risky, just because each buy now, pay later provider has different sets of data. And so if you took that customer and took them to several BNPL providers, someone say yes, someone say no. And so if you give the merchants a aggregation tool, it can improve the coverage rate of getting a yes decision on BNPL, which improves checkout rates for them. Something completely different to the UK or the US markets, where any of the BNPL providers has a pretty good data view of everybody. And so if they say yes or no, is more to do with your credit risk as an individual. So great kind of spotting a good tool that will get merchants to adopt, get them to take the risk on moving to a new payment provider, and gives genuine benefit. But why did we do the deal? Because we love the founders. Stroll, Gareth, and Emil were all working at SumUp before in the leadership team there, doing payments in the region for offline merchants, saw the gap in the market, have a deep payments history, and said, hey, we want to go and build to fix this space. And that's what we got excited about. We got excited about backing the individuals.
So they were really essentially like a very unfair...
Just what about defensibility? Aggregation can often sort of become a race to the bottom as well.
Yep.
So how do you deal with that?
Yeah, I mean, so from a tactics point of view, the BNPL aggregation layer is a good hook to get people to onboard merchants early doors, because it's a differentiated offering. Other people, I'm sure, will build out the same offering over time, and that'll go away. But the long-term aim and what we're backing is the team's ability to build out a really great payments solution for the region, where, because they integrate the local currencies, they put all the love and effort into making it specialized to the region, they'll be able to offer a better price more competitively than the big international players. And if you can, and kind of e-commerce and online adoption in those Eastern European countries like Romania and Slovenia and Greece and Bulgaria is now hitting that inflection point where it's starting to really motor upwards, having lagged behind Western Europe for years and years. If you look at where payment volumes are going to boom online over the next decade, Eastern Europe, for sure.
Sorry, Thomas, I interrupted you.
No worries. So far, I mean, we almost have the impression that if I have any sort of ideas, I would come to you and you will send me a check. Maybe it's very simplistic way of seeing things, but I'm sure that in reality,
sadly,
you say no.
Yeah, I say no 99% of the time. Sadly.
Yeah, I was going to say that. So you say no 99% of the time. And what are the recurring aspects or topics where you essentially say no, it's not for us and will never be for us?
Yeah. So a lot of the time we're not convinced that this is going to be a number 1, 2, or 3 issue for customers to fix. Yes, it's a pain point, but it's going to be issue number 10 for them to fix. And so they're never going to prioritize it. And so you'll never get that level of market pull, and you'll just be fighting an uphill battle the whole way. Sometimes kind of we think that the pain point might be quite interesting, but the product articulation is really poor. So we don't think that the founders often have got good insight into how to build to fix the pain point. Sometimes it's just don't get excited by the founders. You come out of a meeting feeling a bit limp and drab and going, look, I just didn't get excited that they sold me the vision really well, and find it a bit difficult personally to go back and say, the reason we're passing is that we think you're a bit rubbish. So you usually come up with another reason alongside that. But if we think they're a bit rubbish, there's probably another reason there. Well, we talk about the it's usually not just that everything else is perfect and we think the founder is rubbish. so there's usually a chend of things then. And the other thing is it's competitive. We don't have an infinite supply of money. We're trying to do 8 to 10 deals a year. And so we're looking at the rolling pipeline quality and going, hey, if we do this deal, that's one of the tickets for the year gone. Do we think this can be one of the top 10 deals we see this year? Do we want to make a commitment here, or is there something better? And that's the ones that are really hard, where you have the pitch, we debate it around the IC as partners, and it's just not quite exciting enough. It's kind of 9.5 out of 10 exciting, and it needs to be 11 out of 10 exciting for us to want to do the deal.
Oh, wow. Yeah, that makes sense. Yeah, so 11 out of 10, that's a that's a high bar. But at the same time, you have successful businesses going through that all the time as well, right? So you mentioned how many? It was over 100 that you'd already backed successfully, right?
Yeah, so Passion's backed 110, just over that. Historically, we're adding to that total with somewhere between 8 to 10 new deals a year.
Okay, yeah, great. Yeah, so there's been some fantastic founders clearly, which is great.
Yeah.
Just in terms of the process, because I think that was difficult for me as a founder. It was always hard to understand the process because the process is very different between angels, where you might just have a call and somebody might invest in just off the basis of that, and a VC where you have multiple meetings where the VC seems very excited. Then it gets to a IC stage and you might not hear back. So sometimes it's a question of the process and understanding how many stages there are within the process of raising with you. So I'd love to understand a little bit more about how the process works with you. So how many meetings it usually takes and where the IC is, and I guess at what point you hear that you're not going to be successful or successful.
Yeah. So really simple for us. So there's 4 partners. We want to get to the point where all of the partners have met all of the founders. Ideally, there will be some in-person meeting somewhere in the mix there. Now, if the founders are all based out in Bulgaria, that just might not be possible from a logistics point of view. So it might be all on Zoom. But it's still good to be a bit old-fashioned and look someone in the whites of the eyes and make sure they're not a kind of deep fake video avatar that's taking our money. It typically takes us 3 or 4 calls to get through the process and get to the point of making an offer through to a founder. And that'll be kind of just gradually adding more partners into the team and gradually getting to meet the rest of the founders. Like, I think it's probably the right idea for founders not to turn up as the full founding team on the first call, because it gives a good excuse to get a second call. Hey, you haven't met my co-founder. Do you want to have a second call and meet them? You've got to have the hook both ways. And I think you made a really good point. Like, it sometimes can feel quite sudden for founders, and that's because this is a two-way sales process. Like, very obviously the founders are pitching us and they're selling the company idea. But equally, we're pitching the founders about how great we are and how enthusiastic we are and how we'll be a great partner for them. Because if it's a competitive process, we want them to pick us. And we want them to pick us not because we've cut the biggest ticket at the highest price, but because we've cut a reasonable sized ticket at a decent kind of fair price, but because they think they're going to want to work with us for the next 10 years potentially. And that means that we're kind of full sales mode and enthusiastic and talking about how great we're going to be as investors, right up until the point that we say, actually, we don't like this. And so that I'm sure that can be a bit sudden. I kind of think that the further someone's got in the process, the more feedback I need to give them. And so we spend a lot of time with founders, then I'll kind of give them a quick email kind of saying, hey, we're passing, this is why, but I'll also jump on a follow-up call if they want to really dig into the reasoning and get some feedback on why we view something whatever way. Some people find it helpful, some people don't, but just trying to do a bit of a kind of quid pro quo for the time they spent with us.
Yeah, that's a really interesting point. And you mentioning that it's a two-way process, I guess. If you are one of those 1%, then there's probably a couple of VCs looking at you as well and being interested. So it's really interesting that you say that too. So often founders think, oh, I've had some amazing success, and it sounds like they're really excited, and then there's no callback for the second meeting or the third meeting, for example. So it's really important to understand where you really stand in terms of the likelihood of things going ahead for a founder, I think. And that makes a lot of sense. And just in terms of the materials, so because you're building such a big project, right? And very early on, I mean, at later stages, you would have a data room, a financial model, you would have a deck, you would have all these information bits that you need. What do you really need? Like, what is really important? Of course, you're going to want to see that information, but what is the most important thing you look at the pre-seed stage in terms of the information and documentation?
I mean, so we're very written diligence light in our process, deliberately, because we're optimizing for the people judgment and we're optimizing for speed. But we have done deals where we haven't seen a deck, where a deck has not existed until after we have committed into the round, because we've just talked to the founders about their vision. The deck is usually a great way for founders to put down their clarified articulation of their proposition. But we also don't want founders that can only read the deck out and don't have any more depth beyond that. And so I like having the kind of free-flowing conversation where we get off topic and we dive into customer motivations. Why might they buy? What are the pain points? What's going to really click for them? And if you stretch them around the conversation, you see how well they know the subject matter. Have they really put their homework into the space? Yeah, financial models and roadmaps and all these things, not particularly helpful because they've got so many assumptions in them. Everything changes so fast at that point in time that your roadmap will change from month to month. What's at the top of the do next list, depending on the feedback you get from early customers. And the financial model, we basically assume cost only And what's your burn if you get zero revenue? And that's the default case for us. Revenue is upside.
Yeah, great.
Good to know. And just maybe, so we've spoken a lot about like competitive process, hype, in the AI space today. Do you have any maybe example of moments where you had like a very strong conviction on a specific market or maybe specific solutions, where the rest of the market, so other VCs were just saying like, it's not for us because it's overcrowded or because X and Y, but you've seen something particular, you followed your gut or your analysis, or both, and you ended up, finding something great.
Is one of the things that came really clear when we looked at like the historical data, just from passion, over the last 10 years of the early winners that came out of a fund where, say, our second fund was a 2015 fund. If you'd sat down with kind of Robert or the partners at the time in kind of 2016 or 2017 and said, which are going to be the big winners in this fund, different set of names to the ones that have actually turned out to be the big winners 10 years later. Even when you've been invested for 12, 18 months, it's not obvious what those big winners are going to be. Otherwise, you'd expect that kind of pre-seed investors would have perfect follow-on track records for where they followed the money on. So, yeah, we've done deals in the last year where we went and showed them to a bunch of other VCs and said, hey, we've committed, we want to back this founder, we think they're doing something interesting. And every other VC said, don't see it, market's too small, it's going to take too long. And we said, that's fine. We'll still do the deal because we like the founders. And there are other VCs who will have done the same to us, where they've said, hey, there's this deal that we're doing in the fintech space. And we've said, don't see it, don't get excited enough about it. And who knows, time will tell. We'll have to check back in 10 years' time, and I'll be able to tell you whether those ones were the right ones or the wrong ones. But it's the real challenge of the game is that the feedback cycles are long for VCs. But we want to make our decisions in isolation and then work with the founders to get the best investors around the cap table. But if everyone else is saying no, we'll double check and think, are we missing something? And we'll probably come to the conclusion, we still like the founders. Let's back them.
Interesting. Yeah. Moving on to a different topic. So just, I know it's very important to have a board, but at what stage does it make sense to bring in another couple of individuals, to help manage the business for you, right? It's important to understand at what stage that makes sense. So what does an effective board look like for you at the seed stage?
Yeah, and so it's one of the things we work with on our portfolio companies is good governance at the appropriate stage. There is no point having formal board meetings for a pre-seed startup that's got no customers, no employees, than just a couple of founders. We usually have a board instituted, but the frequency of the board meetings is pretty low. At the pre-seed stage, we're working to the point by the time they go out to raise a Series A, there's more of a regular cadence of board-like meetings and reporting, and there's like revenue and pipeline and conversion and all this stuff that we can report on and debate at the board. And so we're trying to find a natural flip point when it goes from regular catch-ups to regular board meetings. And oftentimes external, like non-investor people on the board, that might even be a Series B stage or post-Series A ask on the thing. The one thing that we are checking with founders up front is that we say to them, we want to talk to you. If the founders if they want to take our money and not talk to us, then that's not going to be the right fit for them, because we think we can be helpful. But we're not going to be able to be helpful if we don't know what's happening in the business. So we want to have those regular discussions, and we want to make sure we know what's going on and make sure there's a willingness to move towards adding the more formal board pieces of governance in over time.
And so talking about this, like when you are in situations where you challenge founders and management teams, and how do you make sure that you don't break your relationship with them? Like if your opinions diverge, how do you make sure that you make your point? And because you are not managing the company, you're not in control of the company either. So how do you make sure that you make your message, be received in the end?
Yeah, I mean, at the end of the day, we're an advisor, not a kind of CEO. It's not up to us to execute. It's up to us to throw our thoughts in, to give a clear steer. We can if we think they're being particularly foolish, we can give the extra detail. We can go into past case studies. We can connect them with other founders who've been there and lived the pain. So it's not just us saying, hey, I can tell you a story about this founder who went through a similar problem 2-3 years ago, and this is why they tried what you were doing. It turned out to be a mistake, and so they did something else. You say, why don't you talk to them? I'll make the connection, and you can hear from them firsthand. So you can try and reinforce the message and get founders to take multiple points of feedback on board. But at the end of the day, we're backing the founders to execute. And so the belief it has to still be in, we're sitting a half step removed from the company. We're not in the day-to-day flow. We don't have all the information. Sometimes that can be an advantage that gives you perspective. Sometimes it means that we're missing some of the context. And that's why it seems the course of action should be one way and not the other. We're big believers. We support the founders, and that'll get us to good outcomes in the end of it. And we're not there trying to dictate.
So on a personal basis, how do you deal with remuneration in general, like for founders? Because I assume you don't want them to be paid $500,000 a year without proper execution. But I mean, you don't want them to earn like 15K a year. So how do you deal with remuneration with those very early stage founders?
It is really tough. And actually, we've got quite a broad range of salaries. So we think about we note down what the salary is going to be for the founders post-round, and we have a discussion about it. I typically say to them two things. I share some data with them on both what the range of where the average is and what the range is within our portfolio, and some broader European benchmarks for them. And then I say it's an attitudinal thing. This should feel painful for you at this point in your career. We're at pre-seed, we're lean, there's no revenue, we're trying to maximize where the runway should go. It should feel lean. It should feel a bit painful. It should feel like you're sacrificing. But I don't want to put you in any financial distress. Because if you feel like you need to go and do a side job and work in the evenings or do a bit of consulting to pick up some extra income, that's a really bad outcome for us as investors. If you're worried about, so it depends. Life situations are going to really impact on this. If you've got a sick parent or if you've got young kids, your day-to-day bills are going to be higher than if you're young by yourself, happy to live in a house share with a bunch of other people. And so it's trying to find the appropriate level. And we end up saying to the founders, you tell me the number. Here's the data. And can you say that you're feeling the pain on this salary? And that translates to different actual numbers as an outcome for people. The founders who end up saying, I need to be paid a higher amount at pre-seed, they're not going to get a pay rise because they're going to be closer to the kind of already at Series A salary early doors. And they've got to be comfortable that that means they can hire one less engineer if they've got 3 co-founders on a higher salary. The ones who are on a lower salary, then we're going to be encouraging them to bump up over time as the company gets some revenue in, as they go and raise their next round. Let's make sure you get you onto stable footing. And that actually runs the whole way through. We'll turn around to our founders at the Series B stage and say, you should take a bit of cash off the table. Enough to pay down the mortgage and take the stress off, not enough to buy a boat. I don't want any of my founders owning boats while they're still CEO. So then they go and sail on them and things, and they don't run the company. It's awful.
So, I mean, maybe to close the discussion, so you've spent quite a lot of time now, like in the VC space at the early stage. I mean, you were at Oxford Capital, Downing Ventures. You went to Conviction also.
Yep.
But now Passion, obviously. In your opinion, what makes a great VC investor? I mean, if you had to recruit someone like you, I mean, who would that person be? What do you think are what makes a great VC investor, you think?
I mean, the fun thing about VC is it's different all over the market. And if you know how one VC ticks, you know how one VC ticks. And there are funds that are really data-driven. There are funds that are really people-driven. If you're investing late or investing early, it's a very different game set. So the important thing if you want to be a VC is to work out like where your comfort zone is in the market, what you enjoy, and where you can actually be helpful to founders. At the early stage, it's all about EQ and it's all about adaptability. Like you need to be able to judge characters, work out who you do and don't like, and work out where you can push boundaries to be helpful to people.
Okay, got it. Well, on that note, Will, thank you very much for your participation. It was a pleasure to have you on Aulium. And I hope we will have you again, like in a very, not too distant future when you have like an amazing exit or when you sign your next deal.
Yeah,
but thank you
great
again.
Fun. Always happy to come back.
Cheers. Thank you very much.
Yeah, thanks so much,
Thanks,
Will.
guys.